Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship, the parent owning over 51% of the subsidiary but not 100%. Therefore, we do have a non-controlling interest. We're going to be concentrating here on the bond sale. Bonds this time being sold from S to P, or S issuing the bonds to P that we're going to have to eliminate. They are issued at a premium. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We have our information for our practice problem. We're going to go through all the information first, and then we're going to go back through and pull pieces of that information as we go through calculations within the practice problem. Here we have P purchased a percentage of S voting common stock on January 1st, 2000 X0. P is going to be the parent. S is going to be the subsidiary. Purchase took place 2000 X1, I should say, 2000 X1. The percentage of stock that was purchased in 2000 X1, January, 90%. Non-controlling interest, therefore, will be 10%. The purchase at book value, meaning there's not going to be any differential. There's the book value and fair value of the assets and liabilities at the point of purchase 2000 X1 were the same. No differential, so that we can concentrate on the new thing happening, that being the bonds that were sold. We could think of them kind of like intercompany bonds. We're going to have to eliminate the transaction that took place. That happened on January 1st, 2000 X1. S sold bonds to P. The par value was 97,000. The percent on the bond, 6%. Years going to be 5 years. The cash received was 101,000. So this time we have S selling to P, so subsidiary to parent. You could think of that kind of like an upstream transaction, but it's really a debt kind of transaction that we're taking a look at. That means that S issued the bonds. Therefore, P paid S, right? S got the money at the point in time of the issuance taking place. S then recording the bond payable on the books as well as the related premium in this case. Then we're going to say that the interest is paid annually. So the interest is paid annually. Fully adjusted equity method is used by P to account for S. Consolidate as of December 31st, 2000 X3. So the consolidation is going to be as of December 31st, 2000 X3. Straight line amortization. So that means, by the way, that's a couple of years after the purchase, which was January 2000 X1. So now it's X3. Okay, so we have the straight line amortization of the premium that we're going to be dealing with. So the premium that we had on the issuance of the bond is amortized using a straight line method. So let's consider what we have on the books for P and S as the point in time or the date that we will be consolidating. Here is our worksheet. So we have P, the parent company, S, the subsidiary. And if we scroll down, this is going to be our information. This is the net income for S. Now, some of the things we're going to highlight, of course, within the consolidation, we know that this one needs to go to zero on P's books using the equity method. This was gotten to with the use of the equity method. That's got to go to zero. We know that the income from S is going to go to zero. So we'll consider how these came about with regards to the equity method. We'll reconstruct them with the equity method, and it's going to be a very straightforward equity method. And then we're going to take a look at the bonds that were issued here, and that's going to be our focus. So we know that S issued the bonds this time. So that means that at the issuance of the bonds, S issued the bonds to P. P then paid S cash for the bonds. S now recording then the bonds on the books at the 97,000 that is owed at the end of maturity of the bonds. The premium on the books at the 1,600. P then is now the one that has the 98,600 in this case, the investment in S's bonds that are going to be recorded on the books. That needs to be reversed, and we would think that we would have interest for the bonds on P's and S's books as well. S then paying the interest to P, right? So they're going to have an expense, and then P having the interest income. Okay, so let's redo the equity method here and think about the equity method. It's going to be a very straightforward type of equity method. We're going to rethink these accounts for P's investment in S and how they came about. We're not going to be posting these, just recalculating them. So we're going to say, all right, well, normally you would take S's net income, revenue minus the expenses. That's going to be the 180. Multiply that times the controlling interest, which was 90% this time. I was going to try to remember, but I couldn't, and I would have gotten it wrong, like for sure. So there's the 98,962. That's going to increase the investment and increase the income from S. That income from S then ties out down here. So that is the income from S, nothing unusual going on for it. We're then going to say, all right, the normal equity method stuff we then do would be the dividends going from S going out. We're going to record the portion that would then be going to P. 19,000 of the dividends times the 90% is going to be the 17,100, cash increasing 17,100. The other side, investment in S for the 17,001 included in this account. This account obviously not tying out to the investment and the investment account here because this is only 1 year of activity. This is a permanent account that has been accumulating since the point in time that the purchase took place. But this one will be eliminated with this item at the 28, or not be eliminated. We've reconstructed this account, the 98,962 matching the 98,962 here. Okay, now let's think about the bonds. So we'll think about, all right, what about the bond transaction? We have P books on the bonds for P's books. Let's see if we can reconstruct what would happen on P's books related to the bonds. Now note that P is actually is not the one that issued the bonds in this case. S issued the bonds. So many times if you're an accounting student, you've often thought about bonds most likely from the issuer. Bonds are kind of funny because when you think about bonds in real life, you're probably more likely to be invested in bonds, at which time you'll be thinking about it as like the purchaser of bonds. And then if you think about bonds in accounting, you're typically doing it as if you're the issuer of the bonds the issuer of the bonds, because you're thinking about it in terms of how you would deal with bonds in order to finance the business. So from an accounting standpoint, you're probably more used to working with bonds as the issuer. So you might, in this case, say, even though, you might be used to thinking about P first, you might say, I'd look at whoever issued the bonds if I'm more comfortable with that. And that would mean that you would go to, in this case, S's side, the issuer of the bonds. And in other words, you would look at whoever actually had the bond payable on the books, right? And then calculate, what would happen from that perspective. But we'll start with the other perspective here because we did that last time. So now we're going to say we're going to look at P's books first, and then we'll go take a look at S's books, the issuer of the bonds. So on P's side, they're going to be the one that's going to be receiving cash, right? Because they originally loaned money to S for the bonds. They purchased the bonds. Then they're going to be paid the interest. So now they're going to be receiving interest, that interest being calculated at the 5,820 cash that they will be receiving. That calculation, if I scroll back up to the bond here, 97,000 times 0.06, and that's going to be the 5,820. So there's the 5,820. Then we're going to have the investment in bonds. That's going to be this one. This needs to go down to what the face amount of the bonds is at the end of the day. So we're going to be amortizing, in essence, the premium, the difference between the face value and what we paid for the bonds, or what P paid for the bonds. So let's do that. We're going to say, all right, well, we had the 97,000. Well, let's do it the other way. We have the 101,000 minus the 97,000. That would be the amount of the premium, or in this case, the amount that we paid over the face amount of the bonds, and we need to amortize that down to zero by the end of the life of the bonds, so that at the end of the life of the bonds, it'll be equal to the face amount of the bonds, which will be that 97,000. We're going to use a straight line method to do that, and we're going to divide it by the number of periods, which this time happens to be 5 years because these are paid each year. If it was semi-annual, we'd have to say 10 years and whatnot. So 5 years and 5 periods. So I'm going to say divided by 5. That's going to be the 800. So then we're going to say the investment's going to have to decrease by the 800. So this account's going to have to go down by the 800. The difference between the 5,820 and that 800 is what's going to be allocated to interest income. So interest income here. So here's interest income, and that's where this 5,020 on P's books goes, or came from. All right, so then we're going to say, let's look at S's side of things. And this is, like I say, probably the one that's more familiar. So you may have started with this. Note here, I'm going to use what we've done up top, because we're going to basically record the flip side of the other side of the table of the transaction. And I'm going to put the cash on top because I think that's easier. It's easier multiple ways. It's easier for me to think about cash first if I was building it from scratch. And it's easier for me to just line these accounts up from top to bottom instead of adjusting the order to put the debits on top. It's a lot easier for me to just put them top to bottom, same way, and then think about what the change is. Well, cash now it's going to be, I'm putting it on top. It'll be a credit for the 5,820. In essence, the calculation is the same. Then this one's basically going to match up against the bond premium. So on this side of things, we're going to say we had bonds on the books for S of the 97,000. Here's the premium on the books. It has a credit balance. It needs to go down. It needs to be amortized down to zero by the end of the bond, over the life of the bond, over the periods that will be covered, which is 5 periods, 5 years, because it's paid annually. And then the difference between those two, and of course the same account as up here, will be the interest expense. So the interest expense then is how this came about down here. There's the interest expense. If we were to think about these two things and say, all right, well, what do we have to eliminate here? We could eliminate the entire thing. We could say, hey, you issued bonds to yourself. You got to eliminate the whole thing, right? We could do that, but we're going to simplify this and say, okay, how can we do this as easily as possible? Well, the cash nets each other out once we consolidate, and then we're left with these 4 accounts, that being the investment in S bonds, the interest income bonds, the bond premium, and the interest expense. Now, the bond premium and the investment in bonds are going to be included in the permanent accounts up top. They'll be included up here. We know that we need to remove them, and then we're going to remove, of course, the interest income and the interest expense, which should be equal and opposite transactions recorded on the income statements. So we can see them clearly here. In practice, of course, we might have other interest income and interest expense involved. We dig through the general ledger and whatnot and see, who we paid the interest income, interest expense to. We should be able to see equal and opposite payments due to and related to the bonds that we can eliminate. So then we can go through our elimination entries. We're going to do our standard kind of elimination entry for the equity type of accounts. And then we'll go through the new thing, that being the bonds. The equity accounts is going to be our straightforward type of entry. Nothing funny going on. So we get to go back to just the pure, removal of equity type of activity here. So we're going to start off, we're going to say, all right, first eliminating entry. Let's first think about this. We got P's books, S's books. We then add them together to get the total. That's our first step. Then we're going to do the elimination or consolidation entries. Those will all go here. I'm going to include everything in this column up to the point in time that we are at the current journal entry, this being the first journal entry that we are dealing with. So then we're going to remove the investment or take away the investment account in S. Now, in this case, it happens to be the entire amount because this is going to be a clean journal entry. We've seen some items in the past or some times in the past where we've deviated from that to try to, think about how we can combine these journal entries in different ways. But this is going to be a straightforward journal entry, so we can remove that. We'll also calculate it another way in a second. Then the common stock, we're going to remove the common stock for S as is the typical procedure. So it's on the books here for S, common stock credit 68,000. We will then do the opposite thing to it, debiting it 68,000. We then have the retained earnings on the books for a credit of 38,000. To remove it, we will do the opposite thing to it, debiting 38,000. We then have the dividends on the books at a debit of 19,000. To remove it, we will do the opposite thing, which is a credit of the 19,000. Then we're going to go down to the income. So we have the income from S. It's going to be removed at the 28,962. We're going to remove that same amount here. We can recalculate it, however, to think about how that amount came about. We saw it in the equity calculation. We could see it again here, taking the net income from S, which is the 32,180, times the controlling interest percent, 90%. There's the 28,962. Then we have the non-controlling interest. The non-controlling interest here, we're going to take the 10%, the non-controlling interest of the net income of S, the 32,180. So the 32,180 times the 10%, 0.1, 3,218. Then we have the non-controlling interest in A. That's going to be posted here. Now, we could think about this a couple different ways. We could take this whole thing and just say that's going to be the plug. That's what we need to be left over. Or we could think about it as assets minus liabilities, or the equity method, or all the middle accounts. So let's break this out. We're going to say, all right, let's construct this number, and let's think about how we would do that 3 ways here. We're going to say, all right, let's take S's assets minus liabilities, pulling out the trusty calculator, doing some calculator practice. 37600 plus 18000 plus 82000 plus 251000 minus 62000 minus 108,820 minus 97000 minus 1600. That's going to be the 119 119,180. If I take that and multiply it times, let's say, the 90%, 0.9, we're going to get the 107,262. I can get to that same beginning number by looking at the equity accounts. Let's do that. 68000 plus 38000 minus 19000 plus, now I'm going to take the net income, which would be all these equities, tying out to that number here, make it a little faster, plus 32180. That's going to be that same 119,180, which should also be calculated. All the middle numbers here should get to that same number. Let's try that. That'll be fun. 68000 plus 38000 plus, let's say, 28962 plus 3218 minus 19000. So there's that same 119,180. And if I multiply that times the non-controlling interest, 10%, that's going to give us the 11,918. So there's our standard kind of removal or eliminating entry. Now let's think about the new thing that happened down here, the new stuff, and that's going to be the bonds. So here we have the elimination entry we've already done. That's going to be in this column. This column is going to include everything we have done up to this point and including this point. Then we're going to think about the bonds. I'm going to think about this in two separate sides, that being the balance sheet side and the income statement side. So remember that P issued the bonds to S. So on the balance sheet side of things, they've got the payable, they've got the premium that they're going to have to be dealing with, and then we'll deal with the income statement later. On P's side, they've got the investment in the bonds that had to be removed. So we just need to remove those. We're just going to say we're just going to take those off the book. So the bond payables on the books at the 97,000 credit, we're going to debit it to take it off the books. Then we have the bond premium on the books at the 1,600 credit, we're going to debit it to take it off the books. Then we have the investment in S bonds at the 98,600. That's on the books as a debit. We're going to credit it to take it off the books. Recording that transaction, this should tie out then. That's going to take the bond payable off the books here. So that's been removed. The bond premium, here's the bond premium being removed. It's going down to 0. The investment in S bonds, here is that, bringing it down as well. Then we're going to go down and look at the income statement side, which of course includes the income, the interest income for P's books and the interest expense for S's books. So these two are overstated. We will simply eliminate them or reverse them. The net effect on net income, by the way, of course, has been removed because they're gonna equal each other out. But we have an overstatement of interest income and expense. So we're gonna say then the income is a credit. We're gonna do the opposite thing to it, debiting it to make it go down to 0, as we have posted here. Then we have the expense on the books as a debit. We will do the opposite thing to it, crediting it to make it go down as well. And that should eliminate those items. If we look at the end result here, we of course have the investment in S down to 0, the income from S down to 0. Then we removed the bond related information with the intercompany bonds, both on the balance sheet side of things and the income statement side of things.